You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Well, we are thinking now about CPI, interest rate hikes or cuts, and the banking crisis. All these things are certainly at the forefront of your attention. I know they're at the forefront of my attention. And of course, our guest, James Locke, PooleLocke.com. That's PooleLocke.com. And James, it's great to have you back on the show. So with everything that's going on, really the banking system is showing fissures, and certainly the odds of a recession increasing dramatically. What does the CPI, how does that figure into this equation?
Yeah. So this soft landing the Federal Reserve is talking about is looking harder and harder to come by. And we can still be hopeful. We're certainly a hopeful, group, humanity, but it's getting harder and harder to come by. And the Federal Reserve really holds all the cards in the sense of what they're going to do with interest rates. And we'll see what happens next week. But as far as the numbers are concerned, we had the CPI came out yesterday, the Consumer Price Index. And, that was, what was that for the month? Up 0.4, and that's 6% year over year. So it's showing a declining inflation rate year over year. But there's actually something I want to touch base on. We always look at things in terms of the last 12 months, and sure, that number ends up being 6%. But you can look at it in different ways. If you look at it, say, over the last 6 months, right? And you take each one of those percentages just for the last 6 months, well, then the inflation rate is really more about 2.1%, right? So now the Fed has all different numbers that they're going to look at. But the question that I am hoping they're asking is, are we reaching the desired inflation level that we want? They're always targeting that 2% number. So at this point, hey, does it make sense to keep pushing those interest rates up since we're actually, in line at the moment, right? And now changing and moving these rates around, it's like turning an aircraft carrier. You don't just do it on the dime. There's a lot of moving parts and moving pieces. So I'm hoping that they're taking a more serious look at whether they should continue to raise rates at all. So then today we saw the producer price index came in. So the producer price index is, not something that is as commonly talked about, but this is what people that are building all the things we're buying, what they're paying for raw materials and things like that. And that came down. It was negative 0.1 for February. So, it means that the producers are paying less, which in turn means that we're going to pay less, which means less inflation. So all of these numbers are pushing along the lines of, I'm hoping the Fed doesn't do anything next week, right? Leave it alone for a little bit, but we're going to see what happens. The bottom line is these are actually good numbers. These are what the Fed was targeting. They're bringing inflation down.
Okay, so if you can believe the numbers in the first place, you always got to qualify it. The concept of a soft landing when the Fed's involved, that's like a guy jumping off a building. And hey, if he hits the awning,
yep,
all right, on his way down, it's still probably going to kill him, but he got a soft landing. Whereas if he misses the awning and he lands on a car or the sidewalk, splat. But either way, the guy is dead, right?
Right. Yeah, and that's the ultimate, is the medicine killing the patient, so to speak, right? Is what the Fed doing going to fix everything by, killing the patient? Well, you got rid of the disease, but the patient's dead. So and that's, as we stand here, that's what it looks like they're doing, right? Because I mean, heaven help us if they come next week and raise interest rates a half a point. You think bank stocks are down a lot now, right? Wait until that happens, and no one will have faith in the financial system.
And we'll see more carnage. Obviously, we'll see more banks crash and burn. Look, the banks that are unhedged in this situation are definitely guilty of gross negligence, because it's not like the interest rates just started going up yesterday. It's been months now. I think it's 6-8 months since it started, maybe longer. So you got to figure these banks, kind of ostrich head in the sand. But now, if we have more banks failing, we're going to start to see the actual money supply decrease, right? And that, for credit and everything else, could prove disastrous.
It can. This is a interesting, real life situation, because my daughter, she's a senior in high school. She's studying American history, and they're going through and talking about essentially the Great Depression, and specifically they're looking at the Dust Bowl and all that sort of stuff, and why that happened and how it happened. And it's really relative to today. Is exactly what you just said, right? If the money supply shrinks up, you get deflation, and then unemployment starts going up. It can spiral out of control, right? Especially when you have runs on banks. So now you get into another kind of regulatory question, right? Like, okay, so the government stepped in and probably did the right thing and said, hey, everyone's money's good, right? Which is far and above, I think, didn't they say that only 10% of the assets were covered under the FDIC? So 90% of these assets at Silicon Valley and Signature are essentially not FDIC insured. So they're going kind of above and beyond. So, does that instigate and say to other banks, okay, we'll take more risk because the government will step in and shore up the problem? All right. So you get into now, how much regulatory, oversight do we need on these things? And, the answer is more, but it shouldn't be the government, as crazy as that sounds, because they're just inefficient at everything they do. So you almost need, God, you almost wish there was like an outside entity that could look at this, because, part of the issue, and this is where, I actually don't think this is as bad as the markets are making it look, right? I mean, I just saw some interviews with the CEO of Schwab, and he's like, hey, bank deposits are up. Like, we're actually putting more money in because we're not doing, we're a conservative organization. We're not doing these risky things. So, me as a inherent trader here, I'm looking at it and saying, all right, well, maybe these things are a buy, right? Because their underlying fundamentals are good. But, any trader will tell you, don't stand in front of the train because you're going to get run over.
So it's interesting, because if we go look at the housing stocks, all right, which to me are the best interest rate indicator, like looking at nat gas prices to figure out what the weather is going to be.
Yep,
is they seem to know. They seem to know before anyone else. And the bank stocks, the housing stocks rather, over the past 6 months, a highly bullish looking chart. When I look at Lennar over the past 6 months, it peaked on February 2nd, but it's not much below it. It peaked at like 108. It's now at $100, give or take.
Right. So it's pretty close.
It's getting close to its peak from February, and certainly interest rate sensitive shares of all of them, housing is the most sensitive. So housing is flashing basically a bullish a bullish note on future interest rate hikes and potential cuts. We could look at Toll Brothers, and again, the chart's like virtually identical over that 6-month period. Same deal, peaked Toll Brothers February 2nd, 66. It's now at 57.5. It's down a little bit, but over the trend itself is flashing green for the housing stocks, which has to mean, in my humble opinion, not being an economist, not having formal training, but having 40 plus years of experience of watching this stuff and watching the Fed, watching the money supply, all these things seem to be pointing to me that regardless what the Fed says, they're going to be cutting rates.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
It has to be coming, and that's why I'm saying I don't know what's going to happen next week with the Fed. If they believe that there isn't going to be further bank debauchery here, then they might stick to their guns and raise it a quarter point, because they are still, their track record says that they act too late and then, act too long. And we're now just moving into the acting too long category. I really hope that they take a pause. Right? That doesn't mean they won't raise it later on if the banking situation kind of simmers down and everyone starts to realize, okay, this was venture capital banking and, crypto related things with one bank, or two banks that were, overstretching their risk. Then sure. The other thing to remember too is, if you look deep into it, while sure, Silicon and Signature, their risk department needed to handle things better. Fed's the reason this happened in the first place, right? Because they're jamming these interest rates up so much that your tech companies, can't get the capital they need. So then they end up drawing down on assets within their bank. So now the reserves within the bank go down, and then other people are pulling money out because the 2-year and the 1-year T-bill is up so high, so that I'm going to leave my money in the checking account. And, it's like a spiraling effect. And, you wonder why all that brain power in the Federal Reserve can't say, hey, did we ever think that maybe, this might cause problems in the banking system if we do it too much too fast? And apparently they didn't say that, and here we are. So I'm really hoping that we see a unchanged, cautiously optimistic wait for, July, when they have their next meeting. I think it's July.
So they'll stay the course for now, and come July, and probably the economy is deteriorating. They're going to start cutting. Do an emergency rate cut between now and July.
They could do that. And they always seem to do things like that, right? Rather than be a little more methodical about things. But that could definitely happen, and at some point, like you said, all you need to do is look at all the indicators, right? And it doesn't necessarily mean that that's going to happen, but we're all sitting here looking at it, and you can't sustain this for too long, people don't believe that the economy is that good. So, you're going to have to do something. And the only tool the Fed has is that interest rate, gun in their hip. So they're going to cut at some point. Question is it 2023? And, maybe this banking crisis has spurred that on a little bit. Maybe it doesn't turn out as bad and it ends up being in 2024. But I'm with you. I mean, there's a recession coming, whether it's a small recession or, the Federal Reserve kills the patient, so to speak, is yet to be seen. Let's hope it's just small.
Right.
And they're going to have to, at some point, start unwinding these interest rate hikes to some level. We're not going back to zero, right? But it's coming down.
And we got deteriorating employment numbers, even though the last report, which probably was cooked like all other reports out of the government these days, not to be too cynical about it, but let's face the facts. They're not in the bad news business. They're in the good news business. And,
the re-election business is what
well, that's it. And people don't re-elect politicians when everything's falling apart.
Right.
But employment numbers definitely, tech layoffs continue, and SVP's dissolution will probably result in more tech layoffs in one form or another. Maybe not to the levels of the big tech, the FANG stocks, but certainly the template is in place. So more importantly, James, what does this mean for Steve Chardonnay and Joe Sixpack?
Well, first off, I don't think you need to worry about the money that you have in your checking account or your bank. I actually think the government is doing the right thing by making sure that, everyone can access their money. So we can at least take a sigh of relief there. The government's pretty good about making sure of that, right? And it's probably the smart move. So we don't need to worry about that, but you need to be, understand that the ability to just pick up a job anywhere, it may be coming to an end. This kind of corona economy that we've had, may be changing because the government isn't just printing money anymore. You're going to have to, imagine this, go out and earn it, right? So spending and things like that. I would say that you need to be a little more focused on being able to pay your bills and stay, kind of within your budget, because we can't rely on double-digit market growth and things like that. And in fact, while we maybe the Fed is able to stave off, like I said, if it's a soft recession, maybe the markets don't plummet, but that doesn't mean they can't slowly drift down to, where we were. We're back under 4,000 on the S&P. I mean, there's no reason it can't go all the way down 3,500, 34, just slowly drifting down, because the economy is not, doing anything, and that's not helping your bank account in any way. So, you're not gonna be able to rely on the market, kind of how we have, for way too long.
And we would be remiss if we didn't look at precious metals, gold. Today, as we're speaking, it's March 15th, and gold's up $30 the ounce on the spot market to 1933. A lot of what you're saying, I think, if we start seeing it breaking through 2,000 away, then we know that a lot of trouble is on the way. One thing, what you're talking about, handling the banking crisis, basically, and correct me if my opinion is wrong, by backstopping all the deposits in Signature and in SVP, they've effectively sent out the message to the entire banking system that, depositors are going to be protected. Personally, I think it's a good thing that the shareholders and the
bondholders,
the bondholders get wiped, because that brings some risk back to these investments, and it's signaling the market we're not going to have a rerun of 08 and 09 where the banks get bailed out and they get to keep the managements in place that actually put them in this situation.
That's right. And, we're going to see, they're going to investigate the management here in these two banks. And, we'll see if there was anything. I doubt there was anything illegal. You know what I mean? Too much risk, that sort of thing, not doing a good job. Sure, that means you get fired and that sort of thing. And I'm with you 100%. I agree totally. The stockholders and shareholders and bond, whatever thing, you took an investment and you took a risk, and the management here didn't, do the right job, and therefore you're going to lose your investment. Whereas keeping the people's, assets and essentially the money supply from going haywire because of poor investment decisions by the management of two banks, that doesn't make sense. So I agree that the government has done the best they could in a difficult situation by insuring the deposits, but letting the bank go under. It's about
it almost makes you wish we had really free markets and have to sort all this out. But look, you can't take a risk at this day and age of reverting to free markets and then destroying the entire global economic system. That's not going to work.
Right.
That's certainly not going to get you reelected, is it?
No, not at all. And if we kind of went back to that methodology, then gold is cheap at $2,000 an ounce. Yeah,
Or it might be expensive because 90% of the market of the money supply will be destroyed, right?
Right. Yeah. I mean, exactly. It's like anything. It's, if you had a crystal ball and you could look into the future, you would know. So we'll see what happens. Like I said, this is really within the Fed's grasp. And if they don't do anything stupid, hopefully, hey, maybe we could have the soft landing, right? Like, don't hold your breath for rather have, 3% inflation and continue to try and fight it than have the entire monetary system, have systemic failure. Don't be tunnel vision there, Fed.
Exactly. I would make one other point. Normally when you have these bank failures, collapses, what the FDIC will do is auction off the bank.
Right.
But they haven't had failures in any meaningful numbers in so many years that they've forgotten how to do it. Now it looks like the experienced people are in charge. They're going to auction off SVP, probably to a private equity group. Who knows? Maybe Elon Musk will buy it.
Yeah.
That would be the ultimate irony, I think. But we'll see what happens here. Hey, go over to PooleLock.com. The link is in the show notes to this interview on financialsurvivalnetwork.com. While you're at it, shoot us an email, leave a YouTube comment, and we'll talk to you again, James, hopefully prior to when the Fed finally reverses course, and then we can hopefully get an indication of where they're heading.
Yes, we'll see.
All right, we'll talk to you soon. Thanks for stopping by.
Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.